Hello, ladies and gentlemen. This is Thomas Fross here with Fross and Fross Wealth Management, where we attempt to be the voice of reason in a crazy world full of the pundits of pessimism and the wall of worry. As always, please make sure you read the disclosures that were attached to this email, or if you happen to be watching this video on social media, you can simply go to www.frossandfross.com and read any of the disclosures that you might find therein. So, it seems like the markets are up, the markets are down, inflation begins to look better, then it looks worse. And the fact is, it can be hard to tell what's happening when there's really no clear path in either direction. However, there are some similarities between our current environment and that of 2000 through 2001. But at the same time, there are some real clear differences. As you know, you've probably heard me say that history might not repeat itself, but it rhymes really well. In this update, what I thought I would do is go over those similarities and at the same time the differences in order just to give us an effort to make some sense of where we are and where things might go in the near future. So let's start with the similarities. Number one, interest rates. The Fed raised rates 6 times back between June of 1999 and June of 2000. Now, back then, the inflation rate had more than doubled, and rate hikes were focused on calming markets, exuberance, and the equity bubble. While the specifics were different during that time, the result was the same. We entered into a bear market. Second similarity is the economy. On the whole, the economy was pretty strong in 2000, though a short recession did happen, resulting in 2 straight quarters of economic contraction. This time around, the economy has shown similar strength, with GDP in the final 2 quarters of 2022 averaging 3%. And let's talk about bubbles. There were certainly bubbles in 2000 through 2001 that burst, specifically the tech bubble. And while today we're watching the crypto and the meme stock bubbles burst, in both instances, stocks experienced a bear market. Let's look at 3 differences. A more aggressive Fed. Inflation rose to 3.8% in 2000. Wouldn't it be nice if we were there? Last year, inflation peaked at 9.1%. This has caused the Fed to take a very aggressive approach to rate hikes, bringing the rate to nearly 5% versus the 2% total rate hikes between 1999 and 2001. Second difference, due to the large amount of pandemic-related stimulus, the effects of unwinding that aid have had a longer-term impact on the economic environment. Also, the bear market of 2000 through 2001 was caused by a bubble in the tech sector, while this bear market resulted from more traditional cyclical monetary policy forces. So going forward, we believe that a mild recession is most likely, as the Fed will probably continue to raise rates, albeit at a slower pace than what they did last year. And we're expecting at this point, most likely a quarter point at a time. Markets may continue to be turbulent for a bit of time. However, as history has shown, we do see a strong bull market emerging on the other side. And as I've said many, many times, this too shall pass. Well, please have a wonderful week. Enjoy this summer-like weather if you happen to be in Florida. And we look forward to seeing all of you very soon. Have a wonderful day.